Hello, this is Victor Cuevas with Victor for Advice. I just wanted to make a quick video because of what's going on with the market lately. Now, in the last few days, the market has been erratic to say the least. We were just feeling exuberant. Many people were right before Christmas when the market hit 18,000 and people said we're off to the races. Well, some people said that, and now we're down almost 1,000 points. So what's going on? Well, I'm not going to get into all the reasons why things are happening, other than the fact that most people just aren't sure anymore what to think. They thought the market was doing well, and now it's doing all these crazy things. And when I do my research and I listen to a lot of the people who know a lot more about these things than I do, they're just as confused as anybody else. There's all kinds of different reasons or different prognostications of what's going to happen over the next 12 months. They range from it's going to tank to, well, it's, we're going to have a decent year, but it may be in the single digits, all the way to, well, you should probably be in bonds right now. I don't know if that's the answer. And then we even have some people that are predicting a depression, even worse than the Great Recession we had. So, I mean, what are we to make of it, and where do we go from here? Well, I'm going to try to answer some of those questions in a short video, not to get technical or get into all kinds of different things, but just share some thoughts and where you might want to be looking at going forward as far as how to save your money for the future, where to put it, and to make sure that you come out of this 5, 10, 15 years down the road better off than you are now. Stick with me. Okay, here you see a chart of the Dow Jones, and it's a 6-month chart. You see up here at the top, 6 month. You see what the Dow is right now. If you look over here to the right, you'll see this blue shows where the Dow is now, and when I move this thing around, you'll see that black arrow, and that shows where the stock market is on that particular date. If you follow that dotted line all the way to the bottom, you'll see January 8th at the bottom of your screen, January 8th, 2015, and that black dot denotes that specific date. The black arrow shows what the Dow was on that date. I'm just going to refer to the Dow as the market. So we can just travel all the way around here and we can just kind of see what's going on. So we see that on the far right that it's at 17,320 right now as of yesterday. And if we go back 6 months, we'll see on July 16th, 2014, the Dow was at, look to the far right of the screen, the Dow was at 17,138. So for a whole 6 months, what we see the market is only up a couple of hundred points. Look what has gone on over the last 6 months. Look at this roller coaster ride. Phenomenal. So it starts out 6 months ago at 17,138, promptly went down to 16,300, almost 1,000 point drop by August 7th. That quick. And then it started going up again, and here we are on September 19th at 17,200. Hey, we're feeling pretty good. We've come out of that hole. We're going to finish strong that year. So September 19th, it's at 17,200. What happens? By October 16th, back down to 16,100. More than 1,000 point drop. And you're going, what in the world is going on? And then the market goes on a tear. So from October 16th, it goes up and up and up, all the way up until we hit December 5th. And we're pushing 18,000, and boy, the news is going, we're going to break 18,000. We're going to finally hit that ceiling of 18,000, and we're going to go through it. That's December 5th. Then all of a sudden it drops down like a rock. December 16th is down to 17,000. Another 900-point drop. And right about this time you're thinking, man, this is crazy. This whole year is going to go down in flames. We're going to end up the year way down. All of a sudden, here it is on December 16th, right? It's 17.3. And just like that, we hit, let's see here, on the 23rd of December, we bust 18,000. We close above 18,000. I mean, that's crazy. And it stays there for 3 days. And then it slips off, and then we end the year up here at 17.8 is what it opened the year at. That's what it ended the year up, and it opened the year at 17.8. So you're thinking, okay, we started at we started over here at 17.3. We end the year at 17.8. Pretty good. Not so good, because here it is 2 weeks later, and we're down to 17.3, almost where we started at 6 months ago. So for those of you who said, wow, it's time to get in the market now, I've been holding off, well, you haven't lost any money, but you really haven't made very much, and you've gone through some gut-wrenching ups and downs during that time. So you're saying, Victor, that's only 6 months. Come on now, well, let's look some more. Let's go back a year. Well, this is a year, and we see that a year ago the stock market was at 16.4, and of course right now it's 17.3, and you're saying, well, that's not bad. But let's see how it started out 12 months ago. So again, January 17th, we're at 16.4. You see all the way to the right, the black arrow says 16.4. What happened a few days later? It goes from January 17th at 16.4. Now we're at February 3rd, and we're at 15.3. It starts out with a 1,000-point drop last year. I mean, can you imagine if the stock market goes down some more? I mean, what do you think it started out? I mean, people were going, I remember that last year. It was horrible. January was a rough month. And then it goes on a tear for the rest of the year. Up and down, up and down, up and down, up and down. And then the last 6 months, as we see here. So, I want you to look at another chart. We're going to go back 10 years. Now, this is going to include the Great Recession, folks. Now, suppose you would have been here, bottom of the screen to the left, you'll see February 1st, 2005. Stock market was at 10.7. But you're saying, well, hey, that's great, Victor. I mean, if I would have been in the stock market back in February 5th, February 1st of 2005, I'd be sitting pretty good right now. Well, you know what? Most people, after the Great Recession, got out of the market, and they missed most of that upswing. But let's look at it. If you'd have started in the market in 2005, February 1st at 10.7, in 2007, you'd be at, what is it here? September 30th, 2007, you'd be at 17.3. You're feeling pretty good. And then it happens. First of all, in August 2007, the mortgage industry collapses. I know. I was in the real estate market. I was in Atlanta flipping houses, making tons of money. And then August of 2007, the mortgage industry collapses. And it all went away. Everything. All the income, the business, it all just poof, literally overnight. I lost it all. Along with a lot of people in the real estate business. Because look what happened. That followed the stock market tanking. So here you are in the stock market thinking you're doing pretty good, and 17.3, and boom. By February 1st of 2009, you had 7,000. So September 30th, you're at 13.9. I don't know why I said before, but it's 13.9. All of a sudden, you're down to 7,000. That's almost a 50% drop, folks. That's crazy. And then it took several years. So if you were back here in 2005 at 10.7, it'd have been March of 2010 before you'd have broke over that. I mean, you'd have been in the market for 5 years and you would have just broke even. That's 2010. Then you go over here to August of 2011, you're still not much higher up. That's pretty gut-wrenching for most people. And if you were during this time and you retired, money in your 401k, you're toast. Your retirement income is not going to be anywhere what you wanted it to be. So I'm going to come back to this 10-year graph to show you how you could have come out of this period smelling like a rose with a lot of money. So, last chart I want you to see, I'm going to go to max. This goes back all the way, folks, to January of 1985, when the market was at 1,286. It's at 17,000. Well, if you'd have dumped a bunch of money in an index fund with the Dow Jones in January of 1985 and let it ride for all these years, you'd probably be somewhat of a rich man, depending on how much money you put in it. But that's not the way life works, is it? You see, I want you to look at this very closely. Stay with me here. Look at these years in the 80s and 90s. Steady, steady, no big ups and downs, hardly. Oh, you got a little blip right there. That's what that called a Black Monday there, where everybody freaked out and the market went down a lot. But look at this, relatively speaking, not that big a deal. All of a sudden we get to what? 1998. But that recovered, and all of a sudden we hit January of 2000, folks. December 1999, the stock market is at 11,497. Got it? Look at the stock market since December 1999. Look where the finger is, the dotted line. Go to the bottom. It says December 1999. Look at the far right of your screen. You see the black arrow. It says 11,497. Yes, the stock market right now is at 17.3, but look what you see in the graph and compare that to pre-1999. Compare. That's 15 years, folks, on one side. And it is crazy. Look at that graph. What I want you to realize, folks, is that a lot of the guys that are out there, the gurus that are trying to figure out what's going on and telling you how to invest your money, they started in the 90s and 80s when the stock market was kind of behaving in a way that you could have a pretty good idea of how to figure it out. Since the turn of the century, the stock market is, you can't even figure it out anymore. Everything that these guys have thought and every prediction that they have made, just about every single prediction, has been wrong. We've had look at here folks, two major recessions during this time. You thought 2002 and 1, thought that was bad. Then you had this run up. This was just a tease. Because look at this. It went down from this high of 13.9. It went down to here lower. In 2009, the stock market was at, February of 2009, the stock market was at 7,000. Folks, it was higher than that in 1997. Now think about that, folks. Here we are, 2009, and 1997, and the stock market's higher. Look at this. That's more than a 12-year period, folks, where you make nothing in the stock market. Here's a long period of time where you didn't make anything in the stock market. So, I'm not saying don't be in the stock market, folks. But if you're going to be in the stock market, you have to, unless you, have millions of dollars to invest personally with some of these gurus out here that may be getting it right, there's only maybe a handful of things that you can do to protect yourself from this, and you've got to learn them. And that's what I'm here to try to show you what I've discovered over this time, because I came into business back here, 1994. That's when I came into business, 93, 94. When I was getting my education in this business from the studies I was doing, and with Prudential and banking, and then doing financial plans during this time right here for school teachers, and right about here during these years right here, I was a financial planner for a firm in Dunwoody, in the Atlanta metro area here. And then I went on my own in 2005. So I got taught a lot by these guys that were back in the 80s. Although I didn't grow up in this business, I always had an out of the box thinking, because I was in law enforcement for so many years. So I didn't believe everything these guys told me. And when this started happening, I very quickly changed to some safe money things that helped my clients. But I'm telling you, this here has really caused me and a lot of people in the industry to just reevaluate everything. Because this is what we can expect going forward, folks. It's not going to be this anymore. You can forget this. That's nice. That's tame. This is crazy right here. There's money to be made, but man, you got to be very careful. You just have to be. Otherwise, you're going to end up with who knows what. And statistically speaking, the average person retiring now has well less than $100,000 in savings for their future. It's sad. So, let's move on to the last few things I want to show you. Well, before I leave here, I'm going to go back to this 10-year. I'm going to show you something called indexing. And your money is not in the market, but you have interest credited to you as if you were in the market. And I'm going to show you how it works here. So this is back to the 10 years where this has been from today, and this is how crazy it is. So here it is, February. If you had invested your money with the index strategy, and I'm going to talk about in a little bit, and you started February 1st, 2005, as it shows in this chart, the market was at 10.7. And let's suppose there's two people, one using the index strategy I'm going to talk to you about, and the other one is just has their money in the market. So you go from February 1st, 2005, you go to February 1st, 2006, and the market is up a little bit, right? And you've made some money. And if you're in the index strategy, what the index strategy does is it looks at the market and it says, okay, we'll give you a percentage of what that market returns that year in interest. They'll cap it. It could be anywhere from 7% or 5 to 7%, all the way up to 15%, depending on which strategy which company you're with, and which financial instrument you're in. So let's just say it's 10%. So whatever the market gives you up to 10%, you're going to get it. And if you have your money directly in the market, of course, it's going to increase in value. But a year later, this strategy looks at it and says, okay, you've got whatever, 3 or 4 or 5% return. We're going to give you that 5% return. We can give you up to 10%. We're going to give you the 5% because that's what the market did. So now we go from February 1st at 10,009. And we're going to go to February 1st of 2007. The market is up to 12,002. And hey, you made a pretty good increase there. It went from 10.9 to 12.2. And so you probably made that 10%. Everybody made money, whether you had the money in the market or whether you have your indexing. But here's the neat thing. The first year you were credited a certain amount of interest, it locked in. And now you have that much money that's going to go forward growing. So then the next year, guess what? You've made your 10%. You get 10% added to your account value. It's locked in. And you get to keep it. It's not going to go back. You know you're not going to lose any of that money. But if you're in a market, you have to hope that the market continues to go up. That's not true compounding interest. That is just an asset of yours either going up in value or going down in value. With the indexing strategy, what's happening is that you're getting true compounding interest. And compounding interest, folks, is very powerful because you never lose any money. You just earn money. So now we're at February 1st, 2007. It's at 12.2. Let's go to 2008. Here we are, February 2008. It's at 12.2 again. Okay, well you're not going to get any interest credited. You're going to stay where you're at. And if you had your money in the market, you'd probably be just right there where you were a year ago. All right. So let's go to February 1st, 2009. There we are, February 1st, 2009. The market is at 7,000. 12,009 and some change, I think is what it was. You've just dropped a few thousand points. If you have your money in the market, guess where you're at? To put it mildly, you're in the toilet. If you're in the indexing strategy and you ended up the year with no gain in the market, guess what happens to your money? It just stays where it's at. You didn't lose anything. You didn't make anything, but you didn't lose anything. I think most people would like not to participate in the market when it goes down. And with the indexing strategy, you don't participate in any market downturns. Remember, you can only make money. You can't lose. Okay, so now let's look at February 1st of 2010. The market is at 10.3. Nice increase from the 7,000s to the 10,000s, right? But if you had your money in the market, you'd still be sad because the market didn't go up enough for you because you're still pretty much in the hole. But that's more than a 10% return, isn't it? So if you'd have been in the index strategy and your cap was 10%, guess what would have been added to your account balance? 10%. you would have had interest of 10% credited. Now, that's pretty good. Nobody else is making money, but if you're an index strategy, you just added 10% to your account value. So you were up here, right? And you stayed up there when this happened. But in the next year, guess what? You went up. So let's go to February here at 10.3. When everybody else still down, you're up here. Look at my finger. You just gone up to this area here because you went up 10%. Now let's look at February. Let's go. That's 2010. Let's go to 2011. February 2011, stock market's up to 12,000. You're still in the hole. But from 10,000 and some change to 2,000, 12,000, you've made some money. Your balance just went up again. If you're in the indexing strategy, your buddy has money in the market, he's still in the hole. So you're at 12.2, February 1st. Let's go to 2012. 12.9. Well, finally, it's getting up there, but have you broken even yet? No, you still haven't broken even, but the market did go up from last year, and guess what? You have your money in the indexing strategy. You made some more money. So that's 3 years of your account value going up, and your buddy who has all his money in the market is still in the hole. Now your friend's money starts to go up, but so does yours. Now, since you're capped at 10%, maybe he's made more money in a couple of years here, but he still hasn't caught up with you because he stayed several years down here while you were going up. So that's one way that you can weather these storms and not lose a penny by using this indexing strategy I'll be talking to you about here in a couple of minutes. So hold on to your hats, stay with me as we leave this chart and go on to the next phase of this presentation. Save money. Keep what you earn. Don't risk what you work so hard to accumulate. As you saw in the chart, investing in the stock market isn't what it used to be. If you aren't careful, you may do more harm than good. If you want to invest in the stock market with some of your money, you can in such a way that it greatly minimizes any losses you may incur while still getting a good return. I can't discuss securities during this presentation due to compliance concerns. You will want to contact me personally to learn more. Here are two of the best ways to save for your future without risk: life insurance and fixed annuities. Now stay with me here, folks. You're about to learn something new for most people and very powerful. There are two types of life insurance that work well for safe money. Number one is whole life, designed to generate cash. And then there's indexed universal life, also designed to generate cash. A properly structured whole life policy designed to specifically generate cash can average 4 to 6% and more over several years. When you consider this as tax deferred and compounding growth, it's even better. But when you realize all the money earned can pay you a sizable tax-free income in retirement, a retirement income that you cannot live, well, then it really starts to get exciting. An indexed universal life policy specifically designed to generate cash can earn upwards of 15% and more in 1 year, safely, without risk, and without taxation. Remember what I talked about when I showed you the stock market chart? I explained index investing, where your money earns interest based on the stock market index without the money being in the market. I said you make money when the market is up and you keep your money when the market tanks. And this is compounding interest I'm talking about. Another benefit of safe money in a specifically designed cash value policy is that you can borrow from it. You can get to a point when you no longer need to go to banks for loans. You keep the principal and interest in your policy and grow your cash value even more. You finance your way to wealth. You can't do that in the market. I wonder why banks, by far, are the largest purchasers of cash value life insurance. They own billions and billions of dollars of cash value insurance. Do they know something you don't? You see, banks realize that cash value insurance is an excellent place to store your safe money. It's tax deferred and tax free, as well as sheltered from creditors. It just keeps earning money year after year, no matter what. By the way, whole life insurance through mutual companies was started by Benjamin Franklin and other very smart people he partnered with in the late 1750s. It's tried and proven for hundreds of years. A spin-off from cash value life insurance is a single premium life insurance policy. It's a great way to leave money tax-free to your heirs and to provide for your chronic care needs at the same time. This insurance can almost double your existing estate and allows you to leave much more money to your heirs tax-free. Plus, if you end up in a long-term care situation, it can help out there as well. I don't have time to go into specifics on all this now, but I would explain it in more detail in future videos. But you can contact me anytime for more details and to learn how it can work for you. That brings me to annuities, fixed annuities and fixed indexed annuities. That's right, indexed investing is used in annuities as well. Oh, by the way, annuities have been in existence in America since the 1600s. Babe Ruth didn't lose his wealth during the Great Depression because his money was in annuities. When the stock market crashed and thousands of banks failed, his annuities kept paying him interest each year. He became richer. Since the Great Recession that hit us in 2008, thousands of banks failed. Some banks too big to fail had to be bailed out. The stock market failed us too, didn't it? But no one lost money in their fixed annuities. They made money, compounding interest. Need I say more? Money grows safely in annuities tax deferred. And annuities do something else. They pay lifelong income guaranteed. Annuities are the only financial instrument that can guarantee you a lifetime income you will never outlive. So, you can grow your money safely without risk of loss, and you can get a decent return on your savings. You grow your money in tried and proven ways that have worked for hundreds of years, no matter what. You need to look at annuities and specifically design cash value life insurance policies for a good portion of your money. How can you make money safely and predictably when the market is so unpredictable? How can you stop worrying about your financial future when even the top financial gurus don't know what will happen? I think you know the answer to those questions by now. Contact me right away to learn more. On my website, victorforadvice.com, you can click on Safe Money Places on the menu bar. Be sure to scroll down to the bottom and subscribe to our free newsletter, Safe Money News. Be safe with your money, folks. Retire in wealth, not in debt. This is Victor Cuevas, Victor for Advice. God bless, and I'll talk to you soon. Thanks for watching this video. I hope you learned a few things, maybe have a different perspective on what's going on out there. Maybe you've got a little hope now that, hey, you can go forward with your money. You don't have to be afraid of investing your money, so that now you can be assured that you can grow your nest egg, grow your savings for the future, have it there for you, guaranteed no matter what. And then when you do get ready to retire, then you can look forward to a lifetime of income that you never have to worry about, no matter what. If there's any other questions I can answer for you, or if you would like to see how these strategies or principles can be applied in your personal situation, give me a call or email me, and I will be happy to get with you and review your situation and see what we can make happen for you. God bless, take care, and we'll talk to you later.